अस्सलाम वालेकुम। आज आपकी मुलाकात डॉक्टर तलत अफजा से मनी एंड बैंकिंग के 12th लेक्चर में हो रही है। हमारा आज का लेक्चर बेसिकली पिछले ही लेक्चर की कंटिन्यूशन है, इसलिए आई वुड लाइक कि फर्स्ट ऑफ ऑल वी शुड रिवाइज व्हाट वी हैव डन इन द प्रीवियस लेक्चर एंड देन विल स्टार्ट आवर न्यू टॉपिक टुडे। ट्राई टू रिकॉल कि पिछले लेक्चर में वी वर टॉकिंग अबाउट द रिस्क। Risk basically is the uncertainty which is related to certain future outcomes. Formally, if we say that we have to define risk, so we will be saying that risk is the uncertainty related to the future payoffs of a particular investment in relation to a benchmark investment. And then we also said that we can measure the risk. When it comes to the measurement of the risk, we said since it can be quantified, so we can measure it with the help of the probability distribution. Most commonly used measure of risk is the standard deviation and the variance. But in order to calculate the standard deviation or the variance, we have to get help from the probability distribution. What basically is a probability distribution? A probability distribution is listing all possible outcomes with their respective probabilities. We should list all the possible outcomes and then the respective probability of each outcome. And we say that our probability can never be negative. The value of the probabilities for each respective outcome comes in the range of 0 and 1. The probability of an impossible outcome is 0 and the probability of a certain event is 1. In between we have the positive decimal points for the probabilities. When we add up all the respective probabilities, they should always sum up to 1. When we come to the measurement of the risk, first of all we need to calculate the expected return. And we said the expected return for any particular investment is taking all the payoffs and multiplying them with the respective probabilities. Adding them together gives us the expected value of that particular investment. What does this expected value tell us? The expected value tells that on average this particular investment project is going to give us this particular payoff. When we talk about the risk is related to the uncertainty. So here we take a focal point or a central point which is the expected value. And then we take each payoff of a particular investment and then take the deviation from the expected value. There is a possibility that payoff can be higher or lower than the expected value. So there is always a possibility of a positive deviation as well as the negative deviation. So then, in order to take care of the negative and the positive sign, we square these deviation. First of all, we calculate the expected value, step number 1. Step number 2, we take the deviation of the payoffs from the expected value. In step number 3, we square these deviations. Step number 4, we multiply these squared deviations with the probabilities and then add them together. That gives us the variance. Now the variance is always in terms of squared. If our payoffs are in terms of dollars, then the variance is going to be in terms of the squared dollars. Then there is most commonly used measure of risk which is the standard deviation. Standard deviation is nothing more than the square root of our variance. When we take the square root, our risk comes in terms of dollar. Our payoffs are in dollars and our standard deviation will also be in terms of dollars. So it comes into the same unit. Whereas our variance is in terms of square dollars. So this is the concept of the standard deviation. Now we can also express the standard deviation as a ratio to the original investment. And we can talk in terms of percentages. Previously, अगर आपको याद होगा तो हमने ये कहा था कि when we are calculating the expected values, what we can do is we can take that expected value in terms of the percentage rate of return to the original investment. And the benefit of doing that is that if the size of the investment is not equal, we are talking about two different investments where the original investment is different, then we can calculate the rate of return in terms of percentages for both the investment. And then we can select the one with the higher return. But the story does not end over here. When we have to make a final selection out of these two investments, of course we need to keep an eye on the expected value or the expected return along with the level of the risk. We will be willing to select a particular investment project with the highest possible return with the minimum possible risk. There is another way of doing or saying the same thing. We would like to select an investment project with the higher expected return provided that the risk from both the projects is exactly the same. Which means for a given level of risk, we will select a project with the maximum possible return. Alternatively, we can also say it and express that if the expected return from two investment projects is the same, then we are going to select that project with the minimum possible risk or the lower level of the standard deviation. So when we talk about the calculation of standard deviation and the variance, normally this measure of risk is used when we have to select among the available alternative investment projects. But there is another measure of risk which we call as the value at risk. Now in value at risk, we are trying to look at the risk involved in the worst possible outcome. And there we talked about the situations like, what if we are unable to make the payment for our car which we have already leased out? What if we are unable to pay for our mortgage? So the worst outcomes, the worst possible scenarios can be, we have to surrender the car or we will not have our own house anymore. The value at risk is looking at the worst possible scenarios. Calculation of the standard deviation and the variance is related to the calculation of the risk for various investment projects. And then we said, we can transfer our risk, like insurance premiums. When we pay the insurance premium to an insurance company, what are we trying to do? We are trying to shift our risk to a second party. For example, in case of automobile insurance, we are trying to cover the risk of an accident. By purchasing an insurance, we pay a premium to the insurance company to take our risk. So the insurance company basically will not be willing to take our risk unless the company is being compensated by us. And we compensate the company by paying a premium. So our premium should be high enough that on average, insurance company looks at the claims which are made by different automobile owners. Based on the past experience, they calculate the probability. They look at the expected value. And then the premium we pay to the insurance company is supposed to be higher than that particular expected value. So we cannot shift risk unless we compensate to the individual to whom we are shifting the risk. For example, if we purchase an insurance for our property, so in case of a fire, any other accident, we have shifted the risk, but the expected value of that should be less than the premium we are paying. So this particular attitude we have analyzed with the help of another particular scenario which we call as the risk aversion. Everybody likes to avoid risk. Nobody is willing to take additional risk unless he or she is compensated for taking that additional risk. So when we offer a compensation, we are talking about a risk premium. Now, the risk premium is in relation to a benchmark, and that benchmark is the risk-free rate. A rate normally expressed on the short-term treasury bills by the government. Because most of the time, by the very nature of that treasury bill, number one, it is short-term, number two, it is issued by the government. Therefore, we take it as a proxy for the risk-free rate. After that baseline, as the risk increases, so is the expected return. So the difference between the return on a particular project and the risk-free rate is known as the risk premium. The riskier that project is, the more premium that individual is going to require from that particular investment project. So we can say there is a positive correlation between the risk and the expected return. Higher the risk, higher is the expected return. Definitely, when we talk about any risky investment project, we need to look at the attitude of the individuals towards the risk. And there we talked about 3 different attitudes which we can attribute to the individual investor. We can talk about the risk averse, we can talk about the risk neutral, and we can also talk about the risk lover. The speculators normally they come under the category of the risk lover. Risk neutral needs equal compensation for the same unit of risk, and the risk averse need more compensation for assuming 1 unit of risk. So today we'll continue with the concept of this risk, and there we will look at the scenario how can we evaluate risk from an individual's perspective. There we are going to take an example and see. Later on we'll try to look at the different types of the risk. And we say in general there are 2 different types of risk. One is the systematic risk and the other is unsystematic risk. The systematic risk is also known as the economy-wide risk, general risk, whereas the unsystematic or the idiosyncratic risk is also known as the specific risk. After looking at these 2 different types of the risk, we will discuss how can we reduce the risk. Diversification. Within diversification, we are going to look at 2 different strategies. One is known as hedging the risk and the other one is known as spreading the risk. So first of all, we look at how can we evaluate the risk. So here we are going to continue with the same example which we took in the previous lecture. So we say, let's go back to our previous example where $1,000 yields either 1,400 or 700 with equal probability. This is basically the case number 1 of our previous lecture. There we said, we are going to make an investment worth $1,000. So there are two possibilities. Either the investment will grow to 1,400 or it will go down to 700. The probability of the price going up or the value coming down is equally likely. That is 50% chance for 1,400 and 50% chance for 700. So here what we can do is we can look at the loss and the gain. We have talked about the possible outcome. We have talked about the probability of the outcome. Now let's look at the loss and the gain associated with these two different outcomes or the payoffs of our particular investment of 1,000. So if we look at that, we are evaluating the risk of $1,000 investment. In panel A, we are looking at the gain. Now the gain scenario is where our price goes up or the value of the investment goes up from 1,000 to 1,400. So if it goes up, we have a gain of 400. And what is the probability of the gain? 1 by 2. Or in panel B, we look at the second scenario, the loss. The payoff minus 300 is attached to the possibility of a payoff of 700. 1,000 minus 700 has reduced our price from 1,000 to 700, gives us a loss of minus 300. So overall we can say the gain, payoff is 400, probability is 1 by 2, payoff is 0, probability is 1 by 2. In panel B, we have the payoff of 0, probability 1 by 2, and the payoff of minus 300, probability 1 by 2. Now we have to look at the expected loss and the expected gain. If we look at the expected gain, what do we have here? 400 multiplied by 0.5 plus 0 into 0.5. So we have 200 expected gain. If we look at the expected loss, there we have 0 into 0.5 and then minus 300 into 0.5. So we have minus 150. What should we be deciding? We have an expected gain of 200 and we have an expected loss of minus 150. We should be willing to accept this particular scenario if somebody is offering us more than 200 gain or less than 150 loss. So same thing we can explain in step by step. So how should we be evaluating a particular investment project? Step number 1, we have to list down all the possible outcomes. And then we need to look at the probabilities attached with all of these possible outcomes. Number 3, divide the payoffs into gains and losses. As we have done in the previous slide, we divided into gain and then we divided into loss. And then number 4, ask how much you would be willing to pay to receive the gain, and then ask how much you would be willing to pay to avoid the loss. If you are willing to pay more to receive the gain than to avoid the loss, you should take the risk. As I already said, if you are being offered more than 200 for the gain and less than 150 for the loss, you should go ahead and take the risk. So that we have written as the final step. Once again, you should be willing to pay more to receive the gain than to avoid the loss. You should take the risk. If you are willing to do that, then you should go ahead and take the risk. Otherwise, vice versa, the opposite case, you should be saying no to that particular offer. Now we are talking about the sources of risk. अभी तो हमने ये कहा कि how can we evaluate the risk? But the question arises कि what are the various sources of risk? In our daily lives, there are risks. One type of risk is the risk of having an accident. that is for the automobile owner. The risk of theft, again related to an automobile owner, fire. Then the risk of having a damage to your property. So there you cover it up with the help of insurance, property insurance. Then there are life insurances. The biggest of all the risk of losing the life. So there are various sources. These risks are related to the individuals. But when we talk about the financial risk is related to the possibility of having the losses, the possibility of variation in your expected profits and the actual profit, the possibility of variation in your market shares. For the farmer, the risk of having a bad weather and therefore poor crop. So the risk is everywhere. There are different sources of risk, and the risk varies from one individual to another individual, from one business to another business. But overall, we have to classify the risk. We can classify all sorts of risk into two main categories. Number one is our systematic risk, and number two is our unsystematic risk. Unsystematic risk ko we also call as the idiosyncratic or unique risk which affect only a small number of people. Then is the systematic risk which affects everyone. If we have to take example, if we have to give examples for both of these different types of risk, the first is our unsystematic risk. Idiosyncratic risk, specific risk or unique risk. These are the different names for the same category of risk. So there we say, suppose we are talking about a particular company, for example the automobile producers. If the oil prices, as is the current phenomena, if the oil prices go up, what will happen? The sale of the automobile is supposed to come down. It will affect their production if they are only producing the petrol-based automobiles. But if there are substitutes, as is the case nowadays in case of Pakistan, we do have the substitute, and those substitutes are in the form of having the compressed natural gas as an alternative. But suppose that alternative is not available, then what will happen? In the absence of that alternative or the substitution, what will happen? Immediately you should experience a decrease in the production of petrol-based automobiles. It will affect on the automobile manufacturer more than any other product. Indirectly, petrol is being used in other production processes as well. But the automobile is directly related. So it's going to affect the direct production of the automobile and partially those items where the petrol is being used as an input. Then comes the systematic risk. And the systematic risk, it affects all the economy. Weak indicators, weak economic indicators, which means higher level of inflation, will affect almost everybody from consumer to the producers. Can we do something about these two risks? When we talk about this systematic risk, it's beyond the control of an individual consumer or the business. It's pervasive. It has an economy-wide influence. Therefore, an individual is a very small participant of a large economy. So it cannot be minimized by the individual effort unless the overall economic performance of that particular economy improves. When we talk about the idiosyncratic risk or the specific risk, then there is a possibility that we can minimize the risk. As is the case of the automobile manufacturer, they can shift the production from the petrol-based cars to the CNG-based cars. So they can avoid it partially. The same two different types of risk, which is systematic and the unsystematic. Idiosyncratic, specific, or the economy-wide risk can also be looked at from a different angle. We can talk about these two risks as applicable to one particular manufacturer. And there we see that we can divide the risk into two different categories. And in order to explain it fully, we have this particular diagram on this slide. We are talking about an automobile manufacturing company, ABC. On the top, we have ABC's share of the total automobile industry. When the performance of that company is not sufficient enough, it loses its market share. Then we talk about that particular risk as the idiosyncratic risk or the systematic risk, unsystematic risk, or the company specific risk. Due to the wrong policies or maybe the better performance of the other companies, if the company has experienced a decline in its market share, so that will be classified as the idiosyncratic risk or the company specific risk. And the better policies, more efficient production, and the other strategies can take care of that risk and can result in the previous higher level of market share. So when we say ABC's shares, and then we talk about idiosyncratic risk on the upper portion of this particular slide, we see ABC's share has shrunk. So ABC's share of the existing market shrinks due to the idiosyncratic risk. But when we talk about the systematic risk, overall economy-wide risk, as is the example of the increase in the petrol prices and therefore decrease in the automobile sales, then we see a smaller pie. So we look at the lower half of the slide. So what we see is the systematic risk where the size of the pie has shrunk. But as a percentage of the total pie, ABC's share remains the same. So all the automobile manufacturers, they are experiencing a decline, and therefore overall the market share of the automobile sector has decreased, not the market share of the ABC's company. It's the automobile sector in relation to the total economy. Now the question arises, how can we reduce the risk? Is there any way out to reduce this risk? So the answer to this question is in diversification. That if we hold more than one risky asset, we will be in a position to minimize the risk. There is an old saying that do not put all of your eggs in one basket. What does it mean? That do not invest all of your money in one risky asset. You need to invest in more than one risky asset in order to minimize your risk. And this strategy of investing in more than one risky asset is known as diversification. Practically speaking, we can have two different forms of diversification. One is known as the hedging and other is known as spreading. So we start with the hedging of the risk first. Hedging risk means we try to find out the investments whose returns are moving in the opposite direction. That what we are doing is, both the investments are risky. There is a possibility of gain and loss. level of risk is there, but there is one thing which is very prominent, that if scenario 1 occurs, then we have gain in one investment and we have loss in the other investment. If scenario 2 occurs, then we may have the gain in investment number 2 and the loss in investment number 1. That the value of both of these investments moves in the opposite direction. So the gain of one is compensated with the loss of the other and overall risk is minimized. And this particular policy is known as hedging. Formally, we can say hedging is the strategy of reducing overall risk by making two investments with opposing risk. When one does poorly, the other does well, and vice versa. So while the payoff from each investment is volatile, together their payoffs are stable. वही जैसा कि मैंने पहले कहा कि we are trying to locate two investment opportunities in which one can have the gain and the other one can have the loss. Overall, when we take the average return takes care of the gain and the loss. They are volatile, but putting both of them together into one investment strategy, we are stabilizing our particular return. In order to further elaborate on this concept, we have taken this particular example. So we have payoffs on two separate investments of $100 each. We are talking about two different companies. One is ABC Electronic and the other is XYZ Oil. One is an oil company and the other is an electric manufacturing company. When the oil prices rise, that is first possibility, the share of ABC Electric is worth 100, but XYZ Oil's share is 120 and the probability of increase in the oil price is 1/2. The second possibility is a fall or a decline in the oil price. If the oil prices decline, then the share of the ABC Electronic goes up to 120 and the XYZ Oil price goes down to 100 and the probability is 1/2. What we see here is that when the oil price rises, XYZ Oil Company is experiencing an increase in the price, whereas when the oil prices fall, then ABC Electronic experiencing an increase in price. Now this price increase incidentally is exactly the same, but we have taken this very simple assumption just to elaborate on the concept. In real life scenario, it is very difficult to find out these type of shares where the value increases and decreases are exactly equal to each other. Now we can talk about the investment strategies, and we have to invest certain amount of money, and we can look at three different possibilities. Possibility number 1, invest all the money in XYZ. Possibility 2 is invest all the money in ABC, and possibility 3 is invest 50 in one and the 50 in the other. And that we have reflected on this particular slide. Okay, let's compare three strategies for investing $100 given the relationship shown in the previous table. Strategy number 1, invest 100 in ABC Electronics. Strategy number 2, invest 100 in XYZ Oil, and number 3 is a combination of the two. Invest half in each company, 50 in ABC and 50 in XYZ. If we do that, we need to look at the payoffs. पहले हमने ये कहा कि जब भी हम डाइवर्सिफिकेशन की बात करते हैं, we are holding more than one risky assets. Individually, the return of these assets are volatile, but when we put them into one portfolio, then the returns are stable. So we have these calculations now. Results of possible investment strategies, hedging risk with initial investment equal to $100. We have listed three investment strategies. Number 1, invest all the money in ABC. Payoff is 110 and standard deviation is 10. How did we calculate the payoff and the standard deviation using the same two old formulas. 120 into 50% plus 100 into 50%. Adding them together, we have 110 as the expected return. उसके बाद जब हम x, y, z में जाते हैं, the same scenario. We have two possibilities, 120 with 50% and then 100 with 50% and then again expected return is 110. How did we calculate the standard deviation? With the help of the same formula for calculation of the standard deviation. That we take the sum of the squared deviation from these expected value and then multiply it by respective probabilities, add them up together and then taking the square root of that is our standard deviation. So we have calculated the standard deviation for strategy 1 ABC only 10, strategy 2 ABC only 10. So whether we go for the ABC or we go for XYZ only, the payoffs, expected payoff 110, standard deviation for both of these strategies is also 10, the same, and we become indifferent. But when we go for the third strategy where we are saying 50% in XYZ and 50% in ABC, then what we have is expected payoff remains the same 110, but the standard deviation has gone to 0. And this is the essence of this particular risk reducing strategy. That our expected return has not fallen, is exactly the same, but our standard deviation has gone to 0. Individually standard deviation was 10 and 10, but now it has come down to 0. So this was our first strategy of diversifying the risk, which was hedging risk. Now we are coming to the second strategy, which is spreading risk. Now in this particular strategy, investment don't always move predictably in opposite direction. If you look at the real life scenario, it is very difficult to find out the companies where the risk is moving in the opposite direction. Increase in the price of one and the decrease in the price of one under the same scenario. Practically, अगर आप stock exchange में भी देखें, when the market index goes up, the majority of the share prices, they follow the same trend. It is very difficult to find out the shares of the companies जिनकी prices जो हैं वो कम हो जाएं. इसीलिए hedging the strategy, hedging risk strategy is not as practical as we have the second alternative of spreading the risk. In spreading the risk, we are trying to dilute the risk by investing in more than one particular share investment. So here you can lower risk by simply spreading it around and finding investments whose payoffs are completely unrelated. The more independent sources of risk you hold, the lower your overall risk. That here we are saying that we do not try to find out those investment opportunities जिसमें कि आपका risk जो है वो opposite direction में जाए. Rather here we are trying to find out the investment propositions where our risk is unrelated. And even the sources of risk for these different categories are different. They are totally unrelated. And in this particular scenario, the more independent the sources of risk are, the more effective this strategy of spreading the risk is. When I said that we should diversify, I said practically speaking, there is a proverb that do not put all of your eggs in one basket. When we are saying do not put all the eggs in one basket, we are talking about spreading the risks, putting your eggs in different baskets. So here we may talk about Instead of making all the investment in the stock exchange, you may invest in the property, real estate, you may invest in the stock exchange, you may go for international investments, you may go for a small size business. So we are talking about undertaking those investment projects where the payoffs of the different projects are having different sources of risk. Of course, we cannot avoid this systematic risk. If the overall economic conditions are not good, it's going to hurt all of our investments. But when it comes to this unsystematic risk, idiosyncratic risk, the sources of that risk should be different and independent. More formally, we say adding more and more independent sources of risk reduces the standard deviation until it becomes negligible. So here we take an example. Consider 3 investment strategies. Investing in ABC, number 2, investing in EFG, soft only, and number 3, half in ABC and half in EFG. We should make a note of one thing, and that one thing is both of these companies, ABC and EFG, they are unrelated. Previously, when we were talking about finding out those industries जो कि आपस में opposite direction में move कर रही थी, there we took the example of oil producing firm and the electronic manufacturing firm. But here we are talking about a scenario in which we have a software production company and another company is an electronic producing company, and they are not directly related, they are independent. तो यहाँ पे हम क्या कर रहे हैं, we are trying to find out 2 unrelated industries, and we say as we diversify, instead of making investment only in one company or the other company, if we go for 50% in one and the 50% in other, our standard deviation will become negligible. So let's take certain numerical values and try to prove our point. The expected payoff on each of these strategies is the same, that is $110. For the first 2 strategies, 100 in either company, the standard deviation is still 10, just as it was before. For simplicity, हम क्या कर रहे हैं, हम वही figures लेके चल रहे हैं. But the only assumption is now these 2 companies are unrelated, independent of each other. अगर हम invest करें 100% in ABC or 100% in the second company EFG, our expected payoffs will remain the same, 110. And our standard deviation is also 10. But for the third strategy, where we have 50 in ABC and 50 in EFG, the analysis is more complicated. There are 4 possible outcomes, 2 for each stock. क्योंकि अब जो हमारे stocks हैं, they are independently moving, उनकी prices जो हैं. And when we are talking about 50% investment in one company and 50% investment in the other company, we can have 4 possible outcomes as reflected on this particular slide. Payoffs from investing $50 in each of the 2 stocks, initial investment is equal to 100. We have 4 possible outcomes or the 4 possibilities, 1, 2, 3 and 4. ABC and EFG soft. We invest 60, ABC, EFG soft 60. Total payoffs are 120. Initial investment is 100, but 60 payoff for ABC and 60 payoff for EFG, and total payoffs are 120, and the probability is 1 by 4. Second possibility, 60 ABC shares. Now EFG soft share is 50. Total payoff is 110 and the probability is 1 by 4. Scenario number 3, 50 ABC shares and EFG's payoff is 60. Payoff is 110 and probability is 1 by 4. If you look at scenario number 2 and 3, they are exactly the same what it was in the previous example. But because of the unrelated field of these 2 firms, we have added possibility number 1 and possibility number 4, and the probability has also changed from 1 by 2 in the previous example to 1 by 4 for each of these 4 possible outcomes. अब हमारा fourth possibility क्या है? 50 ABC and 50 for EFG. Now the total payouts are 100 and the probability is 1/4. अब हम calculate करते हैं expected payoff and the standard deviation. The results of these possible investment strategies, we are trying to spread risk with an initial investment of 100. The expected payoff for ABC is 110 and standard deviation is also 10. EFG soft में again expected payoff is 110 and the standard deviation is 10. So try to see that the first 2 possibilities with their expected payoff and the standard deviation are exactly the same as before. But the third one, because of the unrelatedness of these 2 companies, independence, we have a different outcome. So half and half, 50% in ABC and 50% in EFG, then our expected payoff is 110, but the standard deviation has gone down to 7.1. And this is the essence of our strategy, that we have spreaded the risk. It has reduced from 10 to 7.1. Overall, when we compare these 2 strategies, strategy number 1, where we are trying to hedge the risk, there we were trying to find out 2 different firms where the outcomes are moving in the opposite direction, payoffs are moving in the opposite direction, but these 2 firms are related. But the strategy number 2, spreading the risk, we are trying to find out 2 particular firms where our payoffs are unrelated. So there we see, as we go for more and more diversification, our risk is going to go down. And in our example, it has reduced from 10 to 7.1. तो ये तो था हमारा आज का लेक्चर. इससे पहले कि we wind up our today's lecture, I would like to revise कि आज हमने कौन कौन से टॉपिक्स जो हैं वो कवर किए. Today we started with the same topic of the risk. याद होगा कि previous lecture में भी we were talking about measuring the risk. And we said, how can we measure risk? And there we said, we can measure the risk with the help of the standard deviation or the variance. Or another way to look at the risk is looking at the value at risk. Then we talked about the risk premium and the risk aversions. Today, we said, how can we evaluate the risk for ourselves? There we said we need to look at the expected value of the gain and the expected value of the loss, and if the expected value of the gain is higher than the expected value of the loss and we are willing to pay for that, we should go ahead and undertake the risk. Then we said, what are the different sources of risk? And there we said, broadly speaking, we can categorize our risk into 2 categories. The first category is idiosyncratic risk or the specific risk. इसको हम unsystematic risk भी कहते हैं. The other category is the systematic or the economy-wide risk. Then we said, how can we diversify the risk? How can we minimize risk? We said diversification is a way out. Within the diversification, we said there are 2 possibilities. The first possibility is we go for hedging. In hedging, we try to find out those investment opportunities in which the payoffs move in the opposite directions. And there we can minimize the risk. And the second strategy, where we are talking about spreading the risk, there we are trying to find out the possibilities of investments whose payoffs are unrelated. And there, as we add more and more, we minimize our risk. Overall, our expected value may remain the same, but with investment in unrelated types of investment opportunities are going to minimize our standard deviation or the measure of risk. तो ये तो था हमारा आज का लेक्चर. तो इंशाल्लाह अगले लेक्चर में we are going to start with the topic of the bond. याद होगा कि पिछले चंद एक लेक्चर्स में, शुरू के लेक्चर्स में, when we were talking about the financial instrument, उन financial instruments में एक इंस्ट्रूमेंट हमारा बॉन्ड का भी था. So we are going to talk about the bond, उसकी डिटेल क्या है, उसकी वेरियस टाइप्स क्या है, एंड देन हाउ कैन वी फाइंड आउट द वैल्यू ऑफ द डिफरेंट टाइप्स ऑफ बॉन्ड. तो इंशाल्लाह अगले लेक्चर में फिर मुलाकात होगी. आज के लिए डॉक्टर तालत को इजाजत दीजिए. अल्लाह हाफिज.